Most people watch the stock market daily, tracking every tick of the S&P 500 or the NASDAQ. They celebrate when the screen is green and panic when it turns red. But while the world is distracted by the scoreboard, they are ignoring the shifting foundation of the stadium itself, the national debt. There is a massive, fundamental difference between the stock market and the national debt. If you do not understand how these two titans collide, your savings, your retirement, and your future purchasing power are at risk. Welcome to Wealth Alchemy. Today we are going deep, far beyond the 30-second sound bites you hear on the evening news. We are looking at the $34 trillion elephant in the room that no one wants to talk about. Most people operate under the illusion that the stock market is the economy. It's not. The market is a reflection of corporate earnings and investor sentiment. The debt, however, is a reflection of decades of government overspending and structural deficits. When these two forces eventually collide, the normal person, the one who followed the traditional rules, is the one who pays the price. In this masterclass, we will dismantle the difference between these two forces and provide you with the ultimate crisis survival blueprint. To understand the crisis, we must first understand the engine of growth. Stocks are equity. When you buy a stock, you aren't just buying a ticker symbol. You are buying a piece of human ingenuity. You own a share of the patents, the physical products, the real estate, and the future profits of companies that are constantly fighting to be better, faster, and more efficient. Why do stocks usually go up over the long term? Because humans are biologically hardwired to innovate. We find ways to do more with less. This is the alchemy of productivity. In a healthy system, the stock market represents the collective success of our society's ability to create value. But there is a catch that most investors overlook. The modern stock market has become addicted to cheap money. For the last 20 years, companies have used low-interest debt to buy back their own shares, expand their footprints, and artificially inflate their earnings per share. If interest rates are low and money is easy to get, the equity engine roars. But what happens when the government needs that same money to pay off its own massive debts? A competition for capital begins. Suddenly, the cheap money evaporates, and the equity engine begins to sputter. Now we must look at the dark side of the ledger, the national debt. This isn't money invested in future growth. In many cases, it is money already spent on the past. The U.S. Treasury issues bonds, which are essentially IOUs, to fund this debt. For decades, these Treasury bonds were considered the risk-free foundation of the global financial system. They were the safest assets in the world. But as the debt-to-GDP ratio crosses the 120% threshold, the underlying math begins to break. When a government reaches a point where it can no longer pay the interest on its debt through tax revenue alone, it faces a grim reality. It has only two real choices: default or devalue. A formal default, simply refusing to pay, would cause a global collapse, so they will almost certainly choose the second option: devaluation. This means the government, through the central bank, begins to print more currency to satisfy its obligations. This leads us to the invisible tax that eats your life savings: inflation. Your stocks might technically go up in price, but if the dollar loses its value faster than the stock grows, you aren't actually getting richer. You're just standing still while the floor sinks beneath you. Here is the moment of impact where the stock market and the debt meet. When the national debt becomes unsustainable, the Federal Reserve is forced into a corner. They must keep interest rates high enough to attract global buyers for the new debt, yet low enough to keep the economy from crashing. This is a narrow, dangerous tightrope. High rates act like gravity for stocks. They make mortgages expensive for families, car loans impossible for workers, and business expansion far too costly for corporations. We are entering a period where the passive investing strategy of the last 2 decades, just buying an index fund and walking away, may no longer work. You cannot simply buy and hold a currency that is being intentionally devalued to pay off government waste. You must become a strategic alchemist. So, as a normal person, how do you prepare for a debt-driven crisis? It starts with changing your mindset from accumulation to preservation and pivot. First, the liquidity moat. In every financial crash, the normal person is wiped out not because they were wrong about their investments, but because they ran out of cash at the wrong time. When the market drops, people are forced to sell their stocks at the bottom just to pay their rent or buy groceries. Do not be that person. You need a liquidity moat, at least 6 months of living expenses held in a high-yield liquid account. This gives you the stay-in-the-game power that most people lack. Second, hard asset diversification. If the government is printing an unlimited amount of paper currency, you must own things they cannot print. This means diversifying into hard assets. Real estate provides utility and a hedge against inflation. Physical gold has been the ultimate store of value for 5,000 years. And in the modern age, decentralized digital assets like Bitcoin act as a digital lifeboat, operating outside the traditional banking system that is currently weighted down by debt. Third, variable debt elimination. If you are carrying a credit card balance or a personal loan with a variable interest rate, you are in a personal debt crisis right now. When the national debt spikes and interest rates follow, your interest payments could double or triple overnight. Kill your high-interest debt immediately. It is the single best investment you can make for your future security. Fourth, the skill set pivot. In a shifting economy, your greatest asset isn't what's in your bank account. It's what's in your head. The ultimate wealth alchemy is your ability to generate value regardless of what the market is doing. Invest in yourself. Learn high-value skills that are global and digital. Skills in AI, specialized management, or global trade. If your local economy struggles under the weight of debt, your income should not be tied to that single location. The road ahead is undoubtedly volatile, but for the alchemist, volatility is not a threat. It is an opportunity. While others are paralyzed by fear and confusion, you will be prepared with a plan. You must understand the difference between the price of an asset and the value of the currency. Protect your family, diversify your holdings into things that matter, and never stop educating yourself on the mechanics of money. Thank you for joining us for this masterclass. We are living through a historic transformation of the global financial system, and those who pay attention will be the ones who thrive. Remember, at Wealth Alchemy, we don't just follow the markets, we lead our own futures. Our mission is simple: turning knowledge into golden opportunities. If you want to stay ahead of the global markets and navigate the coming debt collision, hit that subscribe button now and turn on your notifications. We are building a community of strategic thinkers who refuse to be victims of the system. Leave a comment below with your biggest concern regarding the national debt or the stock market. We read every single one and use your feedback to shape our future deep dives.